6 weeks ago, a Bank of England rate hike was slowly looking more likely. But now, a June hike looks very much off the table, but July is still alive. And as ever, it all depends on energy flows through the Strait of Hormuz. Now, the big change since the bank's April decision has been the sharp fall in oil prices. Natural gas prices too look remarkably benign. Prices for delivery in 6 to 12 months are within spitting distance of their pre-war levels. And that matters for Britain's household energy bills. They're set to rise by 12% in July, but if nothing changes, they're coming back down again by 8% in October. If that happens, then inflation is unlikely to go above 4% this year, and that questions the need for rate hikes from the Bank of England. Remember, officials have said that simply by not cutting interest rates, something they would have looked to have done had the war in Iran not happened, they are in effect tightening policy. The UK economy is, after all, much less susceptible to the sort of inflation wave we saw 4 years ago. The jobs market is more fragile and wage growth is coming lower too. So where does that leave the outlook for interest rates? A lot will depend on whether an Iran deal can be agreed and whether that leads to a sustained improvement in energy flows. Don't forget, the longer this crisis goes on, the more likely it is that inflation stays elevated. So while it now looks likely that the Bank of England will remain on hold at its June decision, a July rate hike can't be ruled out if the situation in the Middle East doesn't improve.